TSMC earns 45% net margins manufacturing chips for everyone. Intel is now trying to do the same while losing $267 million per quarter. Welcome back. In this video, we're comparing these two foundry giants across technology risk, manufacturing scale, packaging constraints, geopolitical exposure, and whether a true duopoly can actually form. As always, this is not financial advice. Do your own research before investing. For the last decade, TSMC operated as essentially the only game in town for leading-edge logic. That changed in early 2026 when Intel's 18A node entered high-volume manufacturing and TSMC publicly called Intel a formidable competitor, the first time they've said that in over 10 years. The profitability gap between these two companies is about as wide as it gets in semiconductors. TSMC runs at roughly 45% net margins. Intel posted a net loss on nearly $53 billion in revenue, a net margin of negative 0.5%. That's the baseline fact the rest of this comparison sits on. The technical philosophies behind these two companies go in opposite directions. TSMC moves one variable at a time. N3 to N2 introduces nanosheet gate-all-around transistors, and backside power delivery waits for A16 in 2026 to 2027. Intel did something riskier. It deployed both RibbonFET and PowerVia together on 18A simultaneously. So why did Intel take that simultaneous risk? PowerVia's backside power delivery cuts IR drop by around 30% and delivers up to a 4% ISO power performance gain, independent of any transistor improvement. It also frees every front-side metal layer for signal routing, which improves standard cell utilization meaningfully. In simple terms, they move the chip's power supply out of the way of its data pathways. This prevents energy waste and gives the chip a free speed boost, while opening up a ton of space to pack components tighter. Think of it like moving a city's power lines underground, so you can build wider, faster data highways on the surface. Now the density numbers. TSMC's N2 node achieves an estimated 313 million transistors per square millimeter. Intel 18A comes in around 238. That's roughly a 31% gap, and for area-constrained mobile SoCs, that directly determines die size and cost per chip. Density is one thing. Yield is where the unit economics actually get decided. Intel 18A is running at 60 to 65% with a solid improvement trajectory. TSMC N2 launched at 70 to 80%, drawing on years of N3 process heritage. That 10 to 15 percentage point gap translates directly into higher cost per good die for Intel's customers. Yield and density don't exist in isolation. They're shaped by manufacturing scale. TSMC's 2026 CapEx is projected at $52 to $56 billion, roughly 4 times what Intel Foundry is spending annually. Scale accumulates yield data, deepens the EDA ecosystem, and builds customer trust over time. Scale matters even more when you factor in packaging. TSMC's chip on wafer on substrate advanced packaging is effectively sold out through 2026. NVIDIA alone absorbs over 60% of available supply. At this point, the binding constraint on AI hardware deployment isn't the silicon node itself. It's the packaging layer sitting on top of it. That packaging bottleneck we just covered actually creates an opening for Intel. EMIB packaging runs at roughly $35 per unit, compared to about $70 for chip on wafer on substrate. And unlike large silicon interposers, EMIB doesn't hit the reticle limit yield cliff that penalizes oversized assemblies. Packaging cost advantages only matter when customers can afford to build the chips in the first place. Leading-edge wafers are extraordinarily expensive right now. 3-nanometer wafers run around $19,500 each. TSMC's 2-nanometer is projected to exceed $30,000 per wafer. At that price, even a small yield gap means thousands of dollars of cost variance per wafer start. Those wafer prices make geographic concentration a financial risk, not just a geopolitical talking point. Nearly all of TSMC's leading-edge capacity sits in Taiwan, which is why the U.S. CHIPS Act specifically funds Intel's fabs in Arizona and Ohio as sovereign alternatives. Proposed tariffs on Taiwanese semiconductors are compressing what might have been a 5-year diversification timeline into near-term sourcing decisions. The geopolitical tailwind feeds directly into Intel's biggest customer announcement. In April 2026, Intel signed the Terafab partnership with Tesla, SpaceX, and XAI, a $25 billion initial commitment that could scale to $100 billion over 10 years. That $100 billion headline is contingent on those companies hitting aggressive AI compute scaling targets, so near-term revenue remains limited, and the deal structure isn't granular enough to model precisely for now. The Terafab deal is strategically meaningful, but the balance sheet underneath it is under real strain. Intel's free cash flow sits at negative $4.5 billion, and the Fab 34 buyback added roughly $6.5 billion in new debt, pushing total debt to around $53 billion. That leverage is building right as the 14A node ramp begins, with high-NAE UV tools running over $380 million each. This analysis has been rated neutral in both March and April 2026, 3 consecutive neutral readings across about 6 months. The Terafab deal and the Fab 34 reacquisition do make the bull case more credible. But negative free cash flow, that yield gap we covered earlier, and external foundry revenue that's still largely unbooked, keep the risk profile where it was. The most closely watched potential customer is Apple. Reports indicate Apple is evaluating Intel's 18 AP node for entry-level M-series processors, around 15 to 20 million units per year. This isn't about displacing TSMC on iPhone. Apple's A-series flagship silicon almost certainly stays put. It's a geopolitically motivated dual source for lower-volume Mac chips, and that distinction matters for modeling the opportunity. Intel's backside power delivery advantage has a clock on it. TSMC's A16 node uses direct GAA source-drain backside contact, technically a more advanced approach than Intel's NTSV-based PowerVia. The 16 enters high-volume manufacturing sometime in the second half of 2026 through 2027. That gives Intel roughly a 12 to 18-month exclusivity window to lock in design wins before TSMC reclaims that ground. Intel's other strategic lever is UCIe2, an open chiplet interconnect standard that lets fabless designers mix dies from different foundries in one package. That directly undercuts TSMC's proprietary 3D fabric ecosystem, which creates switching costs that keep customers anchored to TSMC. Intel is the only Western-based EMIB and Foveros provider positioned to absorb that demand if the standard gains traction. So the duopoly question isn't whether Intel can technically compete at leading edge. 18 AHVM answers that. The question is whether Intel captures 15 to 20% of sub-2 nanometer external foundry revenue, enough to reach break-even and justify the capital spent, or only 5 to 10%, which doesn't. A small number of major design wins separates those two outcomes. That's the full comparison. 2 companies, 2 strategies, and a very different set of risks and advantages on each side. If you have a take on whether Intel can close the gap on yield, on customers, or on geopolitics, drop it in the comments. Questions are welcome too. Thanks for watching, and I'll see you in the next one.